All right, let's get right into it. We've all seen them, right? The social media gurus, the TikTok tax experts, pitching these secret strategies that sound way too good to be true. Well, today we're taking one of the most popular ones, what I call the YouTube studio mansion play. And we're going to put it under a professional's microscope to see why it's really just a house of cards waiting to collapse.
So this is the question that keeps popping up, and it's the core of what we're tackling. Can I buy a $3 million mansion inside an LLC, rent it back to my own C-corp as a production studio, and then just hammer that income with cost segregation and bonus depreciation to basically pay no tax? I mean, you got to admit, on the surface, it's a slick idea. It tries to link together some real heavy hitters in the tax code. But the question is, does it actually hold up under scrutiny? Let's find out. Here's how we're going to break this down. We're going to look at this exactly like an IRS auditor would. First, we'll map out the strategy as intended. Then, we're going to dissect the 4 massive, unavoidable red flags it triggers: the self-rental rules, the related party issues, the dwelling unit problem, and, of course, the big one, economic substance.
Okay, so first up, let's just quickly walk through the game plan. What's the taxpayer actually trying to accomplish here? What are the moving parts?
The play they're running is pretty simple on paper. Step 1, you, the individual, form an LLC to buy the mansion. Step 2, that LLC turns around and leases the property to your C-corp, claiming it's a production studio. Now the C-corp starts paying hefty rent to the LLC, which creates a huge deduction over at the C-corp. Meanwhile, the LLC takes that rental income, hits it with a cost seg study and 100% bonus depreciation, and generates this enormous paper loss. And the grand finale? The whole point is to take that massive loss and use it to wipe out your other income. Sounds great, right?
Well, here's the first place this whole plan completely falls apart. The entire strategy runs smack into a brick wall called the passive activity loss rules, and more specifically, a nasty little provision we all know and love as the self-rental trap.
For all of us who live and breathe this stuff, you know exactly where I'm going with this. Treasury Regulation 1.469-2F6. This rule was written for this exact scenario, to stop people from manufacturing passive losses to offset their active business income. It's designed to be completely asymmetrical, and it works perfectly.
And here's the punchline. It's a classic heads I win, tails you lose rule, but for the IRS. If this little rental arrangement somehow produces net income, the regs recategorize it as non-passive. But if it generates a net loss, which is the entire reason for doing this, that loss stays passive. It's trapped. It's stuck. You can only use it against other passive income, which you probably don't have. It absolutely cannot touch your C-corp's active income. The whole strategy is dead on arrival.
And before you think, but I'm using a C-corp, that changes things. Nope. The tax court slammed that door shut years ago in Seidel. They made it crystal clear that these self-rental rules apply squarely to rentals to a C-corp where you materially participate. There is no clever workaround here. The very first leg of this strategy is fundamentally broken.
But let's just pretend for a second that wasn't an issue. Let's move on to red flag number 2, the absolute magnet for IRS scrutiny, that is, any related party transaction. The second you're paying yourself, you've painted a giant target on your back.
You know the drill here. An examiner is going to come in and immediately check if this lease looks anything like a real-world arm's-length deal. Is the rent fair market value, or is it conveniently just high enough to create the desired deduction? Is there a real written lease? Any sign that this is just a sweetheart deal between you and yourself, and the whole thing starts to unravel.
And here's where it gets even worse. The IRS doesn't just disallow the deduction. If they find the rent is excessive, they can recharacterize the excess payment. It's no longer a deductible rent expense for your C-corp. Instead, it becomes a non-deductible constructive dividend to you, the shareholder. So you lose the deduction and gain dividend income. Ouch.
And the IRS has all the authority they need to do this thanks to the beast that is Internal Revenue Code Section 482. This gives them sweeping power to reallocate income and deductions between your entities to whatever they would have been in a true arm's-length transaction. They can, and they will, slash that rental deduction.
So we've got passive loss problems and related party problems, but the fun doesn't stop there. Red flag number 3 comes from the very nature of the asset itself. The fact that we're talking about a mansion, a dwelling unit, kicks us into a whole different and much more hostile part of the tax code.
The second your asset is identified as a dwelling unit, you get yanked out of the world of Section 469 and dropped squarely into the penalty box of IRC Section 280A. And that section has its own, much harsher, set of rules about business use of a home.
And don't just take my word for it. Section 469 itself tells you this. There's language right in the code that basically says, hey, if this activity involves a dwelling unit that falls under 280A, then all of our passive loss rules, well, they don't apply anymore. 280A takes over. It's the boss. And its rules are not what this taxpayer wants to hear.
Because under the 280A framework, there's a hard ceiling. You can only take deductions up to the amount of gross income the property generates. You can't go below zero. Section 280A C5 makes it statutorily impossible to generate a net loss from the activity. The entire purpose of the strategy, to create a giant loss, is explicitly forbidden by the law. Game over. Again. All right, so even if this thing could somehow magically get past the first 3 hurdles, it would still have to face the final boss, the ultimate weapon in the IRS's arsenal, the economic substance doctrine. Codified in Section 77010, this is the IRS's power to step back, look at the entire arrangement, and ask a very simple question. Does this make any sense whatsoever outside of just trying to save a boatload on taxes? For a transaction to stand, it has to change your economic position in a real way, and you have to have a substantial non-tax reason for doing it.
So you have to ask yourself, could you sit across from an auditor with a straight face and argue that there was a legitimate, substantial business reason to buy a $3 million mansion to film YouTube videos and structure it in this convoluted way? The argument that this isn't just about creating a tax deduction is, well, it's paper thin.
And failing this test is no joke. It's not just about getting the transaction disallowed. A transaction that lacks economic substance gets hit with a strict liability penalty. If it's undisclosed, we're talking about a staggering 40% penalty under Section 6662I. There is no good faith defense. It's a brutal automatic hit.
So when you put it all together, what's the final verdict? What does the risk actually look like here? Well, to put it mildly, it's an absolute train wreck on every single level.
I mean, just look at this. It's a perfect storm of failure. It's not just one weak link. The entire chain is broken. First, the self-rental rules under 469 trap the loss, making it useless. Then, the related party rules under 482 can reclassify your rent as a non-deductible dividend. On top of that, the dwelling unit rules under 280A say you can't even create a loss in the first place. And if all that wasn't enough, the economic substance doctrine under 77010 can come in, disregard the entire thing, and slap you with a 40% penalty. It doesn't just fail one test, it fails them all spectacularly.
And really, this whole deconstruction brings us to the fundamental question we all grapple with as professionals. Where is that line between good, solid, aggressive tax planning and a transaction that's just a fiction, a sham, that lacks any real economic substance? This studio mansion strategy is a perfect case study of what happens when you leap way, way over that line. It's a powerful reminder that any tax strategy worth its salt has to be grounded in economic reality, not just wishful thinking.